that sets the scene quite nicely for us. So the Global Smaller Companies Trust is a collection of what we think are the very best smaller company ideas globally in one fund. The philosophy is very simple. We take a long-term conservative approach to investing in good quality growing businesses, but we do this in an opportunistic way. We're looking to buy into these high quality companies when they are out of favor and when they are available at a significant discount to what we think they are intrinsically worth. So you can think of this as a quality value strategy. The differentiators of the trust, well, I think that there are quite a few of those. So it always does start with the people that are running the product, and this team is very well resourced. We have 9 people involved with the management of this trust, so it is one of the largest teams that are managing a global small cap mandate. It is a very experienced team. The average experience from this team is 20 years per person. So we've been through numerous market events, and we also know the management teams and the companies very well in this sector, and that allows us to make better and more informed decisions. The philosophy is different from the perspective of we are truly long-term investors. So there are some companies that we've held within this trust for over 15 years, and we're really proud of that. So we've actually seen these companies grow from tiny entities to much more developed businesses. So that's something that we have as a key trait. The other thing to note about the way that we manage money is that we are focused on risk, and not a lot of people talk about risk, but we know that this asset class has a very strong history of outperforming over the long term, because these businesses, smaller companies, generally tend to be not very well known by the market. And as they are discovered, they do tend to see valuations expand. And this asset class generally tends to deliver faster earnings growth. The problem is things go wrong in smaller companies. They are fragile entities. So we think the best way to approach investing in this asset class is to take an approach of trying to deliver the faster earnings growth that is inherent within the asset class, but with lower levels of risk. And we lower risk for our clients by focusing on higher quality companies and by buying them with a margin of safety. So if we're wrong in our analysis, that margin of safety or that discount to what the valuation is intrinsically will protect us on the downside. We offer emerging markets and developed markets in one product, so you wouldn't have to choose between the different regions. We do all of that for you on a bottom-up perspective. As was mentioned earlier, we do pay a dividend, and the dividend has been growing for 55 years consecutively. It's a low-cost offering as well. The ongoing charge is just under 80 basis points. If you turn the slide, Alan, so why do I think the opportunity is so compelling today? So we've been in a very momentum-led market. It's been dominated by larger companies. We don't think that this concept of mean reversion in financial markets is dead. We have seen this sort of cycle before where larger companies have dominated for a long period, and it has always been followed by a sustained and very strong recovery in the smaller companies asset class. So we think that that previous phenomenon of cycles and mean reversion is likely to come back. And indeed, if you look at the relative valuations of smaller companies versus larger companies, they are at those levels that have historically marked the start of a new small cap cycle. So that does get us excited. We think that there are 3 catalysts that can help in bringing the small cap asset class back into favor. 2 of those are shorter term, and 1 of those is longer term. The shorter term catalysts are, first of all, a reacceleration in economic growth. So there is a lot of concern about a slowdown in economic growth because of the imposition of tariffs, and because we have been through a period of inflation for several years, and that has eaten into consumer incomes, particularly in lower income consumers. We think that as economic growth picks up, and as uncertainty clears from tariffs, that benefits smaller companies more than larger companies. The second shorter term catalyst is interest rate cuts. We have seen the start of an interest rate cutting cycle, but it was delayed. And in the US, interest rates have started to be reduced again. So as more cuts come through, that is more helpful for smaller companies than it is for larger companies, because more of them are on floating rate debt, and fewer of them have access to financing. So as rates are cut, that is more helpful for smaller companies than it is for larger companies. And then finally, we do think that the investment environment that we've been so used to has changed. We've been through a long period of low inflation. We've actually been through a period of 40 years of declining inflation. Many of the factors that were helpful in keeping inflation low now look like they are reversing. So, for example, we are now in a period of deglobalization, we're in a period of political change, and we are in a period of conflict as well. And all of those things have historically been inflationary. And that is very helpful for smaller companies, because smaller companies are more exposed to the sectors that do well in inflationary times. And smaller companies, by their very nature as well, do handle inflation better than larger companies. So similar to what we saw in the 1930s and 1970s, periods of high inflation, smaller companies did outperform in those periods. So we're optimistic that those sorts of times can return and smaller companies can come back into favor. So one should think of this trust as a pure play on a recovery in an asset class that is currently out of favor, but we think has got very favorable long-term prospects. If you turn the slide, Alan. So these are the characters behind this trust and the people that manage the assets within this trust. So the way that we organize ourselves is within silos. So we have the North American silo on the left, and I am part of that. So I'm very involved in the North American portfolio. I am also helped by two people, Nick Janvier and Louis Subaka, and a US central research team, which has 27 analysts based in Boston, New York, and other parts of the US. The two columns in the middle are the UK and in Europe. And there are 4 portfolio managers here that are backed up by 15 research analysts in Europe. And then for Japan, we have Daisuke and Alex. So it's a very experienced team that have been doing this for a number of years. If you turn the page over. So this is what we look for in an investment for the Global Smaller Companies Trust. So the first thing we look at is the quality of the business model. And for us, this means that initially we have to be able to understand the business fully. And believe it or not, that actually does rule out a large chunk of our universe, because many loss-making listed businesses tend to be not something that we can understand. We don't know what that business might look like in 10 years' time. We don't know how to value it or where the risks are likely to come from. So we generally don't tend to invest in those types of companies. We invest in businesses that have really strong competitive advantages. So they could be either the lowest cost producer, or they'll have a differentiated product or service. And critically, those advantages we think are sustainable. The companies we invest in tend to operate in industries that are consolidating or that have very high barriers to entry. The businesses that we invest in tend to be very diversified. And that's really important, because many smaller companies, they tend to be over-reliant on one customer or one product or one supplier. And if any of those situations change, then that creates a potentially existential problem for that business. So we tend to avoid those types of situations. We want our companies to have pricing power, to generate lots of cash, to have good balance sheets. Management teams are very important for smaller companies. And the first thing that they need to do is to get the day-to-day operations right. So to have a track record of strong operational performance. We like our management teams to own significant parts of the businesses themselves. We especially like companies that are led by founders, because those companies have a track record of outperforming. And the most important thing is capital allocation. So the management teams have to have a track record of allocating capital efficiently and generating shareholder value from every pound that they spend. That's what we think is a good business. Now, the problem is that these good businesses tend to be very well recognized by the market. And good assets, generally, they can be bad investments if they're bought at the wrong price. So we are very careful in the price that we pay for these companies. And we will look to buy into these companies when they are out of favor, when they might have had a temporary wobble, and the share price is disproportionately fallen, and that has created a long-term opportunity. So we are opportunistic, and we will value the company on a whole host of different metrics. And we will look for that margin of safety, that discount between where the share price is and where the intrinsic value is. So if you turn the slide over, Alan. So if we are doing our job properly and we follow the philosophy and process, then it should show up in the numbers. And if you look at the gross margin, operating margin, and return on equity of the median company in our portfolio versus the benchmark, we do have superior metrics. These are all quality metrics. So our gross margin is 37% versus just under 29% of the benchmark. The operating margin is over 4 percentage points higher. The return on equity is over 4 percentage points higher. The balance sheet strength comes through. We have a median leverage of 0.7 times versus 1.1 times the benchmark. Now, normally, you would expect a higher quality portfolio to have a higher valuation than the benchmark. But we are unreasonable investors. We want high quality, and we also want low valuation. So if you look at the valuation metrics of our portfolio, we're on 1.7 times sales versus 1.8 for the benchmark. The price earnings ratio is lower. It's at 16.9 times versus 19.2 times. And we pay a higher dividend yield. So this is a quality value portfolio, and it shows up in the numbers. So we turn the page over, Alan. So this is our track record over the last 25 years. The philosophy and process works really well. We have compounded our shareholders' capital very nicely. It is up over 7-fold over the last 25 years. Which is well in excess of the MSCI All Country World Small Cap Index, which is up 6.3-fold. The Deutsche Numis Index, which is up 5-fold. And the MSCI World is up 486%. And this includes all the Magnificent Seven and the large cap growth stocks that have done exceptionally well over the last 10 years or so. That is included in that bucket. And the FTSE 100 is up 230%. So we are in excess of all of those benchmarks. Versus the AIC Global Smaller Companies Trust, Global Smaller Companies Index, rather, or the Global Smaller Companies Peer Group. This is the best performing trust within that peer group over 5 years, which is a record that we are proud of. So if you turn the page over, Alan. So I'm going to talk a bit about what we've been doing on the portfolio and how we are positioned, just to give you a flavor of what's been happening. So this is a very diversified trust. And normally when you look at most funds today, they have a really heavy weighting in technology, and they don't have a lot in other parts of the market. And we're actually the polar opposite, because we are opportunistic investors, and we're finding better situations or better opportunities outside of the technology sector. So we only got 7.8% in technology, and we really like industrials at the moment. We've got just under 31% in industrials. From a region perspective, we've got 43% in North America, and a lot of global funds have got over 60% in North America. So we're finding better opportunities in places like Europe, Japan, the emerging markets, which is shown in the rest of the world component here. And in the UK, we've got just under 19%. So that's where we think we have the best opportunities. It's worth mentioning at this stage that our benchmark is a hybrid benchmark. So we have 20% of our benchmark as the UK small cap index, which is the NUMIS index, and 80% is the MSCI World ex UK small cap index. So in terms of positioning, we are overweight Japan by 2.8%. We've been finding really good opportunities in Japan. Ever since the Japanese authorities took corporate reform very seriously, that opened up many opportunities for us. The Tokyo Stock Exchange is trying to delist companies that don't have a credible plan to improve their returns on equity from above 6%, from below 6% to above 6%. And they are looking at delisting companies that are trading below book value that don't have a plan to try and improve shareholder returns. So that has really sparked a revolution in Japan, and many companies are undertaking share buybacks. They are selling non-core assets, and they are there's a lot of cases of activism as well in Japan. So that has been a fruitful hunting ground for us, and we're happy to be overweight there because we think that story has got a long runway of growth. Inflation is also returned to Japan as well, which has improved the nominal growth rates of many businesses. And the new government as well is undertaking fiscal stimulus. So that should be helpful for the local economy and Japanese businesses as a whole. In Europe, the world has changed really over the last couple of years. Europe is now recognized that they have a competitiveness issue, and they're trying to change that situation. They are spending more money on infrastructure and defense, and a lot of those funds will actually be released out into the market next year, which will help many European businesses, particularly those in Germany. And the valuations, they do look attractive in Europe versus other parts of the world. And interest rates have been cut in Europe as well, which is helpful. The rest of the world, we were more underweight than we are today. Today, we're actually quite almost neutral. And the reason we were underweight before is we were a bit worried about the valuations in India, but Indian valuations have actually come in now. The stock market has lagged a little, and the valuations now look really attractive. So we've closed that underweight positioning, and we've got heavy exposure to areas like Indonesia, the Philippines, Vietnam. These are economies that are growing very rapidly. They are benefiting from strong demographics and from a rising middle class. So we're seeing good opportunities in the emerging markets. The UK, we've got 18.7% in the UK. So we are underweight relative to our hybrid benchmark, but we still have a sizable weighting in the UK. Many of our UK businesses are actually international in nature. And one thing we've noticed in the UK is that the valuations are extremely low. It is a very out of favor market. There have been a lot of takeovers in the UK market. We actually benefited from some of those takeovers. So we had 6 takeover bids in the UK portfolio last financial year. We've already had another 3 takeover bids in our UK portfolio this financial year to date. When we come in the morning and we look at the RNSs, the first thing we notice is how many of our UK corporates are buying back stock. It is astonishing. Many of them are buying back stock because their shares are just undervalued on an absolute basis. So that's why we have a sizable weighting in the UK. In North America, there the situation looks a little bit more risky. The valuations look higher. We are seeing more speculative activity. We are seeing the return of those meme stocks that have been in and out of favor over the last couple of years. Many of these companies don't even generate revenues. We don't invest in many of them, but that speculative fever has kind of gripped parts of the smaller North American market. So we are seeing less opportunities there. I'm just going to mention perhaps a few stocks that we've bought in the industrial space, because I know I've said that we have increased our weighting in the industrial space. So to give you an example, earlier this year, we started a position in GTT, which is a French business. And what they do is that they produce the membranes for LNG terminals and vessels. So this is a specialist technology, and customers generally will go with the most reliable and most proven product. And GTT have a 90% market share in this technology. And the customers don't want to take any risks with this technology, because if your LNG vessel leaks, you could have an environmental issue. So they generally will not forsake on quality at all, and they will go with the industry standard. And GTT is the industry standard. With their 90% market share, their know-how, the technology, and their brand, they have a very strong position. They have one of the highest profit margins in the whole of the industrial space in Europe. They make a 60% operating margin, which is unheard of in industrials. And part of the reason why that is because they operate on a licensing model, which is very attractive also from a cash flow perspective. And the reason why we like this business is that the growth prospects are very strong over the next couple of years, because of what happened with the invasion of Ukraine. That shut off gas from Russia into Europe, and Europe is now much more reliant on liquefied natural gas from places like North America and Qatar. And that liquefied natural gas is being transported in these vessels, and they are lined with GTT membranes. So the growth prospects of this business are very strong. They are forecast to grow earnings this year at 25%. And we were able to buy the shares at 14 times earnings, which is very attractive. If you turn the page over, so this is the market environment at the moment and how we position the portfolio. So we are a little bit concerned that we may see a slowdown in economic growth. And as a result of that, we are being careful in the companies that we invest in terms of predictability of earnings. We think that it is better to be in companies that do have higher predictability of earnings and good balance sheets. We're in that part of the cycle now. Profit margins are generally quite high, particularly in North America. So we're avoiding cyclical businesses that are at peak margins. The valuations I've talked about. So we are overweight in places like Japan and Europe, and underweight North America, because that's where the valuation opportunities are. We think that geopolitical tensions are here to stay, and inflation will probably stay higher for longer. So in an environment like that, you do want companies in your portfolio that sell essential products and that do have pricing power, and that do have low valuations, and that generate lots of cash because they don't have a lot of capital needs. And those are the sorts of businesses that we own in the portfolio. And there is a lot of policy uncertainty. Markets are likely to stay volatile. And I think in that type of market backdrop, you do want higher quality companies. You do want a manager that is longer term, that is selective, and that is focused on not only delivering you returns, but also capital preservation. And that's what we look to do. Over the page. So why now? So if we look at smaller companies, the top chart is showing you smaller companies over the long term versus larger companies. And the trend is upwards, but you can see that there are cycles here. And we've been through a long period of underperformance. The valuations of smaller companies versus large companies in the bottom chart. And I've lined up 3 periods when valuations were extremely low. The first period is in the late 1960s, which is at the top of the Nifty 50 boom, when the larger companies did really well, companies like IBM and Kodak. Smaller companies then went on to outperform all the way up to 1983. The second arrow is the late 90s, so the dot-com bubble, when companies like Cisco were on 100 times earnings. Again, smaller companies were one standard deviation cheap, if you look at the bottom chart. They then went on to outperform all the way up to 2012. And then the third arrow on the right-hand side is where we are today. So again, we are one standard deviation cheap. We do think that the valuations are there to mark the start of a new small cap cycle. And once the cycle starts, we think it can last for several years. Historically, these cycles have lasted about 12 years on average. So large caps tend to outperform for 12 years, and then small caps tend to outperform for 12 years, and then vice versa. So if the cycle does turn meaningfully, then we think we're in for a long stretch. I'm going to pause there and open it up for questions, because I know that there'll be areas that I haven't touched already that people want to explore. So I think let's pause there and open up some questions.
Yeah, thanks so much, Nish. One very specific question. Can you talk about the kind of framework in which you invest in terms of position sizes and what the process for picking companies is? What's your in-house research process, and perhaps do you take readings from external research as well? Do you want to talk a little bit about all of that?
Yeah. So there's a lot to unpack there. So maybe I'll start with how we actually find companies. So our universe is really big. So there are over 8,000 smaller companies listed all over the world. And we can't know all 8,000 businesses, but you'd be amazed how many you can discard just because they wouldn't fit our quality criteria. So, if you took out all the loss-making businesses, the companies that don't generate any cash, that have very stretched balance sheets, you could automatically shrink that universe by half. And we see a lot of companies. So as a team, there are 9 of us. So we see about 1,000 companies a year in various parts of the world. So we can quite quickly cover our investment universe just with the size of the team that we have, and by eliminating large parts of the universe that will never make it for us from a quality perspective. So most of our ideas do come from seeing companies. We've built an extensive watch list of businesses that we like, but maybe they're not at the valuation that we want them to be investing in them. So we monitor that on a regular basis. We do have sell-side contacts that do occasionally come up with good ideas, but we use most of the sell-side research, sell-side sort of interaction for information gathering rather than idea generation. And then we'll look at other things as well. So, for example, we do like spin-offs and technical situations, or forced selling, or fund liquidations as a source of idea generation, because those are parts of the market where you do get undervalued stocks. Once we find ideas, we will then put it through our process, and that was the Venn diagram that I did show you earlier. And then it's a case of portfolio construction. So we will look at sizing of a position will be a function of our conviction in the investment thesis, the upside to intrinsic value, and the downside to our bear case value, correlation with the current portfolio as well. So those are the sorts of things that we're looking at when we're looking to size a position. We generally will start at a 75 basis point position, and then we will look to build that up to something like a 1.5% position. But we will allow our winners to run. So we're not capped at the top. we can allow our winners to continue to compound in value. So the classic example of that would be Martin Marietta Materials, for example. So this is a business that I bought into in 2016. So we are truly long-term investors. We've held this for 9 years. When we bought the position, it was under 8 billion in US dollars in market cap, and now it is well north of 30 billion. So we allow these businesses, and it's 30 billion is still a mid cap in the US because the market cap ranges are different for different geographies. So we allow our winners to run.
Yeah, thanks. And it is a really diversified fund, isn't it, compared to, you know, there are competitors who are focus funds who have much larger position sizes and
yeah. So I've been doing this for a long time now, and I've managed different portfolios with different sizes of holdings. So I managed a 50 stock portfolio in small caps, an 80 stock portfolio, and one that has significantly more than 80. So what I can tell you is that smaller companies is more volatile and more risky, and you do want to manage risk well, and that's a key to any long-term track record. So concentrated portfolios in smaller companies is a lot harder than it is in larger companies. So that's why, just from the pains and bruises of previous experiences, we think that actually having a larger portfolio, sufficiently diversified and concentrated with a high active share, is the right way to deliver strong risk-adjusted returns. And we've got a 94% active share in our portfolio. So our portfolio looks very, very different to the benchmark.
Yeah. And related question, the diversification, you do use and have for many years some other collective vehicles,
Yes,
including investment trusts,
yeah,
for some of your exposure. Do you want to talk, without going into delving into every single one, do you want to just talk a little bit about how you use them and what you look for when you select them? I believe I'm right in saying that you've been looking to reduce the exposure to those more recently. If you want to comment on that as well.
Yes. Okay. So at the outset, we wanted to provide one product where our clients would get the very best smaller companies all over the world. Now, we don't think that all of the world is just the developed markets. Actually, we think that some of the very best opportunities today in terms of growth and smaller businesses that are going to be huge businesses in the future are actually in the emerging markets. Now, we would love to have this internal. The issue is that it's a really specialist area, and you need boots on the ground, and you need to know people within the emerging markets, have relationships with families. Many families are involved with listed small cap businesses in the emerging markets, so you need to have a history with those families. You need to know the accounting, the language, and all of those things to do a good job in the emerging market small cap arena. It is a very risky part of the investment universe. If small cap was risky, emerging market small cap is a whole nother level of risk, because there are lots of instances of corruption, fraud, and all kinds of things. And you just wouldn't know that unless you're very familiar with that part of the investment arena. And we don't have that internally, so we use third-party funds. Now, our process for selecting those third-party funds is very rigorous. It's actually backed by a multi-manager process. Now, we've got a very large multi-manager team at Columbia Threadneedle that has locations not only in the UK, but also in the US as well, for US clients. And their process is rigorous. So we use extensive screening and data collection, followed by a very lengthy due diligence process involving meeting the managers and various parts of the manager's organization, understanding the companies, actually going through the company portfolios themselves and looking at the individual businesses. So our funds go through all of that multi-manager process before they make it into this trust. So we want to offer this to our clients to make it a truly one-stop shop solution that gives you developed markets and emerging markets. It's done in a very professional way.
Thanks. And moving on to your portfolio exposure, one of the reasons people buy smaller companies is for diversification, and it's not. And our viewers will understand that your job is not to necessarily think about diversification against other asset classes like large cap, but for somebody coming to this trust new, do you want to talk a little bit about some of your main markets and how the smaller cap segment of those differs from large cap? So when you buy small cap in Europe, you kind of get a free bit of diversification as well as all the interesting companies. Do you want to just expand on that a bit?
Yeah, I'm going to tackle this in a couple of ways. So we've got a couple of slides which might be helpful. So if you want to flick forward a little and maybe go to page 14. Yeah, okay. So we didn't cover this slide, but I think it's instructive because what it's telling you is that the small cap index, which is on the left-hand column here, and the right-hand column is a large cap index, and this is showing you the weightings by sector in the various indices, in the two indices. So small cap is more diversified than large cap is. If you look at large cap, there's a huge weighting in technology. It's like 28% of the large cap index is in technology. But in small cap, it's more information technology is only 12%. And the largest weighting is in industrials, which is just under 20%. And if you think of the industrial sector, so this is companies, services companies, transportation companies, manufacturing, packaging businesses come in here. It's a really wide range of different types of companies. So there's a very, very noticeable divergence in between sectors in small cap versus large cap, where small cap is more of the kind of real world economy and large cap is more kind of towards technology and communication services and the heavy weightings there. So there is an automatic difference there. You are getting more broader diversification in the small cap index than you are in the large cap index. And when you think of small caps just more broadly, it's such a big universe. So I talked about 8,000 companies. So those companies will be doing all kinds of different things. So you're getting that broad spread across the whole economy within that part of the market. If you go back to the team slide, so page 5, I think this is. Yeah. So at the top, you can see the market caps. So in the various regions, so on the left-hand side, you've got North America. So the largest company that we can buy at any given point in time is the largest company within the local index. So the North American portfolio is benchmarked versus the MSCI North America Small Cap Index. And the largest company is $26 billion. Now, that's a function of the small cap market in America. It's just the sizes are just much bigger. In the UK market, on the second-hand column, so this is the Numis index, the largest company is $2.4 billion. In Europe, it's 10.2. In Japan, it's 9.7. So smaller companies are different, they have different definitions in different regions. That's the way we think about it.
Yeah, thanks. And again, I think this is related. And as ever with smaller companies, there's always more questions, but I'm going to make this the last one because we're coming up to time. It's a fairly straightforward one. Do you want to talk about the trust's benchmark? Because obviously you have this UK component, which means the UK is against the world index is overweight. Do you want to talk about the history of that and how that influences your thinking?
Yeah. So believe it or not, we were our benchmark weighting was 40% UK small cap years ago. We're talking like sort of 20 odd years ago. And the UK market was a much bigger part of the overall global stock market. And sadly, that has gone in one direction, and it is much smaller. So we have been reducing down that number. So we went from 40 to 30 to 20 a couple of years ago. And it's always under review. The ultimate destination will probably be an MSCI World Small Cap Index. That seems like a logical kind of direction of travel, but we always review that. That's the history of it. We always thought that the UK market, the UK small cap market, wasn't very well represented by the MSCI UK Small Cap Index. And that most UK small cap managers, and I think this is still true today, try to follow the Numis index rather than the MSCI UK small cap index. The Numis index is the one that is more recognized. So that's why we went for this hybrid structure.
Okay. I think I'm embarrassed to say that I remember, but it's probably also for the precursor to ISAs, PEPs, where having 50% in the UK meant your trust could qualify for a PEP. So that may be where the roots of that lie as well.
Yeah.
So with that, thanks so much, Nish. As I said at the beginning, this is recorded. You'll be able to view it again and download the slides. Nish and his team put plenty of effort into producing a really nice website, and trust me when I say people slave over their reports for the annual report, and so I always recommend people read those. And of course, you can always go to Kepler's Trust Intelligence website for more information as well. Do get in touch if you have other follow-up questions, and thanks everyone for attending, and we'll see you on the next one.
Thanks, Alan. And thank you, everyone.